12 billion rand passing through, and of course ending only just in positive territory on the local front, but there's so much that is occurring right now on a macro level.
Yes, I think the market was incredibly volatile today, like you pointed out, and for much of the afternoon we did trade in positive territory, taking our cue from European markets and the surprise interest rate cut in Euroland. So that came through quite nicely, but like you say, only just closing in positive territory. Quite volatile. The resource companies and the cyclical commodity shares exceptionally volatile today. Platinum, like you mentioned as well. But you know, I think if you looked throughout the day, the defensive sectors did come through quite nicely for most of the day.
With regards to the developments in Europe, the G20 meeting, all those elements that I mentioned a little earlier, I really don't want to repeat them. How important is it with regards to the fortunes of the JSE? Because at the end of the day, it should come down to earnings, and earnings in South Africa are looking good. One only has to look at what happened with Roshini today. We're looking at double-digit growth well into the 20s.
Yes, that is correct, but I think it's also quite diverse within the sectors. So if you look, for example, in the industrial or the financial sector to some degree, there is a lot of certainty on the earnings on those fronts. And like you say, we see them coming through across many of the sectors within industrials and to some degree in financials. At the moment, in the resources sector is where there's a lot of doubt on the earnings going forward, given the commodity price drops that we've seen. And the analysts, you know, in terms of forecast earnings, haven't really brought down earnings. So there is a lot of questions on the resources front, but within financials and industrials, we're looking quite good.
Okay, of course, and resources is what really deciphers the fortunes of the overall JSE index, given the fact that we're very heavily weighted there. I spoke about Roshini, headline earnings per share up around 25.6%. Is it a company that you would buy right now? Because it's always looking expensive, but it's always performing really well.
Yes, I think a very good performance from Roshini. I think especially if you look at it in the context of the 2010 World Cup base that's in the numbers as well. So very good numbers coming through from them. Within the sector, they're actually you know, trading quite at reasonable valuations when you look at them relative to Woolies, for example, or even a Truworths or Mr. Price for that matter. So within the sector, they are looking okay. Very encouraging was their margin expansion, both operating as well as gross margins come through quite nicely on the back of their supply chain initiatives.
Let's touch on Old Mutual. Of course, Nedbank out with its third quarter update, and Old Mutual out with quite good third quarter life sales as well. That was up around 8%. Were you impressed with these numbers?
I think it was a mixed set of results that came through. You know, positive on the volume growth side, especially some of the emerging market numbers that came through very positive. I think the US life business is where the disappointment is, and the outflows that we're seeing in that business. So that is a concern. But overall, I think satisfactory results. The market liked those results that came through today.
Would you be buying Old Mutual right now? Of course, as I mentioned, it's down around 0.3%.
Yeah, I think within the sector we prefer Sanlam. We like the balance sheet in Sanlam, the conservative balance sheet, as well as the expansion into the Indian market, together with the cash that they hold on their balance sheet. So we prefer Sanlam within the sector.
And interestingly, in fact, Credit Suisse said that Sanlam is going the target price around 34 Rand a share and a rating to outperform. So it'll be interesting to see that stock playing out. We had also a business update coming through from Aveng as well in today's session. What is your view? I mean, an increase in the order book as well.
Yes, I think that order book was very important. 18% increase in the order book, quite encouraging. The market liked the number. But I think if you look within the order book, they talk of 85% of that order book attributed to private work as opposed to public work. And within the order book, the South African component, you know, the outlook does not look encouraging. Certainly that's coming through from management.
Is it about margins at the end of the day for these construction companies as opposed to the actual size of the order book?
You know, exactly. I mean, margins are very important, and given the competition and the reduced volumes of work coming through, margins are exceptionally important in the construction shares at the moment. But I think for Aveng, very encouraging is the Australian business together with the African business. That seems to be going ahead very nicely and quite encouraging for them.
Able coming under significant pressure in today's session. What is your sense?
Yeah, I think they, you know, the company missing on the consensus. Consensus is looking for a 27% increase in earnings for the year. You know, the unsecured lending space, we're not that positive on the space, given that a lot of the traditional banks are looking to compete in that space with the Ables and Capitec's of the world. So we're not that positive in the unsecured lending space currently, given the competition issues that potentially face.
So Able down 3% in today's session, you wouldn't be then accumulating at around 34 Rand a share.
No.
Capitec also raising capital
yes.
This week. What is your sense in terms of stock picks within the banking space? Would Capitec still look slightly expensive for you?
Yes, I think so. I think both Able and Capitec, we're happy to stay away from those sectors, but to play in the traditional banking sector for now.
ArcelorMittal is down around 1% today, and also coming out with a third quarter loss, but citing that the next quarter looks slightly better, input costs being a very big issue, lower steel prices. The woes carry on for ArcelorMittal, but the market not punishing it too much today.
Yes. I think, yes, encouraging is the fourth quarter that they've guided to that will turn into positive territory. But I think the steel industry, not only locally but globally, is in a very difficult space. And especially in the South African market, if you look at infrastructure projects that are not coming through, this is not supportive of the steel industry in South Africa. So it is very difficult for ArcelorMittal at the moment. And it's a sector that we're happy to remain out of for the moment. But having said that, if you do see some kind of recovery in the local market or even globally, it does look quite attractive on that basis.
Stock picks at this point in time, can you even make a decision? Could you even commit to a market such as this one? I
think for now, we're still happy to remain defensive, and we have been for a large part of this year invested in the defensive sectors of tobacco, breweries, telcos, healthcare. Those are the sectors that have really performed and have really worked for us. So as a result, you know, these sectors are trading at quite demanding valuations. If you look at SAB Miller, for example, you know, the forward PE on SAB Miller around 16%, so very, very pricey at these levels. But I think investors have had to pay up for this defensiveness. So we're happy for now to hold on to that. Given the whole Greek situation, we think that the sector will continue to hold out.